Hey, Adam Gower here, and welcome to this week's podcast with special guest Chris Fraley, who is Chief Investment Officer at RealtyMogul. Now, my first contact with Chris was a few weeks ago when he emailed me to suggest that I spend some time looking at the Institutional Real Estate Inc. website, IREI. And that ended up leading to a podcast with Jeffrey Dorman over there and a very interesting dive into the intersection of institutional capital, institutional investing, and real estate crowdfunding. And of course, in today's episode, that does feature as part of what we talk about. Now, Chris produced a few slides. So, as these podcasts are always video recorded, if you are listening as an audio podcast, go ahead to GowerCrowd.com and check out the podcast page where you'll be able to see not only Chris and me talking about his slides, but you'll also be able to actually see his slides. Hopefully we cover everything by describing them today. You don't actually need to do that if not necessary. But while you are there at GowerCrowd.com, make sure that you click on the news button at the very top of the page. We have the only news channel that is exclusively dedicated to real estate crowdfunding. There is a mass of information right there for you. It is the motherlode of real estate crowdfunding information, real estate investing information, actually. So go ahead, click on the news button there on the GowerCrowd.com website. And have a look around. I'm sure you'll find a lot of very valuable information. All right, let's turn our attention to my guest, Chris Fraley, Chief Investment Officer at RealtyMogul. He's a super nice guy, very, very bright. We had a bunch of stuff to talk about, and in the hour that we chatted, managed to barely scratch the surface. You'll see exactly what I mean. Here he is. Chris Fraley, Chief Investment Officer at RealtyMogul. I am so happy to see you today. I'm so glad you're on the podcast. Here's the thing. You know I like to have casual conversations, and you've gone ahead and sent me some slides, for heaven's sake. But I know this is so important to understand what is going on here. Tell me, what is the general thesis, first of all? And we haven't even set it up. You can show these slides, but we can do that on the fly while we're talking. What is the general thesis that you wanted to discuss today? Because I know I want to talk about it as well, but I want to hear it from you.
Sure. Yeah. Thanks, Adam, for having me. I really appreciate it. So, when Jillian asked me to be Chief Investment Officer, and actually she had actually asked me to be the interim Chief Investment Officer because I was doing some other things. And frankly, I was actually nervous to take on the role because I came from a very institutional background, and this was, kind of a new thing. And I expected to see, a lot of chaos when I joined there. And after being there for a few months, I realized the opportunity, and frankly, the opportunity is to really disrupt the closed-end private equity fund model that I actually came from, and it was a pretty interesting realization. And the technology allows investors to invest directly into, individual assets.
Right. So hang on, I'm just going to cut you off right there because I want to ask questions. Right.
Sure. Absolutely.
First of all, what exactly is the closed-end private equity fund model that we're disrupting? Just describe that for the one guy out there.
Absolutely. No, great question. So probably at some point in the 90s, the institutional world started trying to figure out ways of investing large sums of capital into real estate managers. And that's pretty much about the time where this model came out. And the way it works is a real estate fund manager would aggregate a pool from institutional investors. And it's really a 10 to 12 year, maybe 9 to 12 year time horizon. The first year is spent raising the capital. and you can do some investing while you're at it. And then typically the fund manager has 3 years to invest the capital. They have 4 years to create the value, and then, usually about 3 years to liquidate. So when an LP, a limited partner, such as a big state pension fund, they'll say, I'm going to put $50 million in XYZ fund. You have full discretion to invest it how you want. And I expect it back in, 10 years with this return. That's basically, and it's closed end rather than open end. Open ended means it doesn't really have a timeline. Typically investors can go in and out. It's often difficult to go out, but there's not a very closed end format to it, unlike an open-ended format.
Okay, and it also has a cap on they decide how much is going to be raised to the fund.
Right.
There's a time period during which and once that finishes, now they're into completing the full life cycle of the fund. It goes full life throughout that 9-10 years, whatever it is.
That's right. Yeah, they usually, in the offering documents, they'll say, our target raise is X. And they can often, if they go beyond that, if they're oversubscribed, you typically have to go back and get permission from the LPs to allow them to do that.
Right. And what's interesting about this, and just to be clear, institutions, we're talking about pension funds, endowments, sovereign wealth funds, possibly insurance companies, etc. Massive funds that aggregate enormous amounts of capital. So it's really a scale issue. Plus, you also have, and this is going to be very important as we get into this, it's some of your slides here, you also have professional managers who run these funds, right? These are people who live, breathe, and eat commercial real estate underwriting and understanding what's going on underneath the hood of these deals. But importantly, I think you said the 90s, and this was thanks to you, I met Jeff Dorman at IREI. Right, when he started was right at the beginning. It's very important for what we're going to be talking about. Right at the very beginning of the era that institutions started looking at real estate. Correct. Mm-hmm. It was just give us a quick snapshot, ever so brief, because it's very important for what we're going to talk about later. They didn't invest in real estate, did they? Until like the 80s? Was it even?
It really wasn't considered a very institutional quality class. There weren't, institutional quality mechanisms. I mean, a pension fund could own a lot of their own real estate on their own book, but then they would have to have their own investment staff to manage it. So it really wasn't until, real estate became an asset class that got a lot of attention within modern portfolio theory and understanding how it correlated with other asset types and so on. So that's really when it started.
Yeah, and so we'll come back to that because it's very important, because from 30 years ago to now, when institutions weren't investing, it went from close to zero to utterly dominating the commercial real estate world, right? So we'll get back to that in a minute. Okay, so your thesis is, and let's look at these slides again, at least hypothetically, just for the time being. Your thesis now, continue your thought process about what started to change now. We've got institutions in commercial real estate dominating the industry, and then suddenly crowdfunding is born. Then what did you see over there that you weren't expecting to see when you got into RealtyMogul?
Well, when the institutions, when I was a partner at Rockwood Capital with a firm with, I think they're probably on their 11th fund at this point, and long history of institutional investing, really in using mainly the allocator model. One thing that probably about 2002, I would say, some of there started to be a lot of noise within the institutional world about what's called the double promote. And what happens with the fund is, so a closed-end fund, a fund manager like a Rockwood or 50 others that are out there, they will charge they'll charge a promote over a pref. So once a real estate developer, they'll provide limited partnership capital to a real estate developer. The real estate developer will, let's say they do a home run, and I have a chart there that shows the numbers, but let's say they have a home run, they have a big IRR. That capital will go into the fund, and then the fund manager will take a promote off of the cash that comes in from the various operators. That's called the double promote. And it can shave 3, 4, sometimes even 500 basis points off the institution's return. And in some cases, look, if there's a great fund manager, the theory is, well, wait a minute, we're receiving 4 or 5% because you just got a 18, 19% return thanks to our investment selection. So but at the same time, the institutional investment world said, well, wait a minute, you're kind of skimming a lot off the top. There's a lot of allocators out there. You're not that special anymore. We want to go directly to the sponsors. Mm-hmm. So really, I would say the group that really led that charge was Yale, the Yale endowment with David Swensen.
Right.
Absolute genius. I think the world of him. So David Swensen had the idea that, well, I'm not going to invest in a fund. I'm going to invest in a sponsor who is perfectly capable. They're institutional quality. They're perfectly capable of managing my capital. I don't need a third party. So Yale poured hundreds of millions of dollars into Shorenstein, for example. They're well-known backer of Shorenstein. Also, they were a big investor in JBG in Washington. So there became this groups that really relied upon the managers to act as fiduciaries. Some pension funds couldn't avoid it. They needed a fiduciary. But some felt that they could just invest directly into, the JBG, and a lot of sponsors, they raised their own fund. They didn't need, the allocators to provide the capital.
Right. And then the other issue, of course, for institutions is ones of scale. I mean, if you go to, well, you talk about allocators, but if you go to a private equity shop, and I worked for one, and we did all of our own deals, but I know that there were those who would look for sponsors. It's harder because you got to find sponsors of scale. If you've got hundreds of millions to invest, you don't have too much of a concentration, and you also don't want your sponsor to have too much of a concentration for you to be dependent.
Right.
But there are issues with that as well.
Sure.
So what did you see at RealtyMogul that kind of started ringing interesting bells? Make it sound like an alarm, but kind of started setting off, wow, this is interesting signals, I should say.
Yeah, I mean, it seems in the long run, crowdfunding tends to give, investors really exactly what they were looking for, institutional quality vetted deals. They can do their own diligence on, all the information and data is there. And it's a very efficient marketplace. And so I envisioned a world, and it's happening as we speak, where technology and access to deal flow disrupts it provides the benefit that was being provided by the closed-end fund managers, which were making hundreds of millions of dollars off of the promotes that they were receiving as investment fund managers.
Now you have actually provided some very interesting charts here. And because this is also going to be audio, let's just pretend that everybody can see them. I can put them up on the screen if you want, but if you want to refer to them as well, Chris, and just kind of walk us through some of these concepts that you've got here, I'd love to hear about it, because what I'm actually really interested in getting to, there are 6, for those who aren't watching, who are listening, there are actually 6 different I don't know, structures that you've described here. It's actually the very, very last one that I think is the most interesting. But I'd love to hear what is the story that you are telling with these charts. If you can describe it rather than showing it, be really helpful.
Yeah, sure. So on the first slide, there's really 2 different ways that capital.
I'll tell you what, while you do that, I'll tell you what, I am going to interrupt you. Why don't you go ahead and actually, for those that are watching, let's have a look at these puppies. I've never done this before. I gave you screen share rights there. Everybody in the world knows what that means these days. So let's just make sure that you get the right thing. Can you go ahead and share?
Yeah, sure.
And then we'll come back to you. Let's stay on video as well so we can see you talking. All right, there we go. Beautiful. I'm going to take that to full screen. Okay. That's fine. Just yeah, to go to the red day. Oh, beautiful. Okay, fabulous.
I'm a pro at this. I do this a lot.
All right, good.
So the first slide is really really what I described about a few minutes ago. First of all, how do funds get to the closed-end fund manager to begin with? And they can go either directly into the closed-end fund manager, or for the really big institutional investors out there, they have to go through what I call gatekeepers. And the gatekeepers are, Cliffwater, PCA, Partners, Callan, ORG, Cambridge. These are groups that vet RFPs from responses to RFPs from fund managers. When a pension fund will say, I need to invest $100 million in multifamily development, and the funds will come in, and then the closed-end fund manager will invest in an operator in the form of a limited partnership investment, and then the operator will buy the real estate.
Right, and just to be clear, they won't just invest in one operator. That closed-end fund manager will have a family, what's the word, a farm of operators that they've screened, they like, they have relationships with, and so they will distribute that 100 million maybe across however many operators.
That's right. Yeah, that's right. That's exactly right. And typically in any fund, you wouldn't want exposure to more than, call it 10%. So if it's $1 billion fund, you probably wouldn't want to invest more than 100 million in one operator. That also gives the institutional investors some diversity as well. And then on the next slide, this shows how the RealtyMogul and frankly the crowdfunding world can disrupt that model, whereby an institutional investor can invest directly into the platform. And I just want to be clear here: we're not the fund managers. We're really a technology platform.
Okay, so this is a very important distinction, because actually I was just about to ask, aren't you now the closed-end fund equivalent? You're not.
No.
But you are providing. So let's think about it this way. Let's kind of frame it in the world that we got. So what the closed-end fund manager, to call him the fund manager did was essentially aggregate information that institutions could come to one source and know that they had access to data across the entire market, were able to invest in multiple deals. They didn't have to go out and find individual sponsors. They went to one fund manager, and that one fund manager had relationships with dozens of sponsors. Now, the model that you're describing on the slide here, which by the way is entitled Direct Investing Model, uses technology to create more effective capital allocation model to adjust immediately to market cycles. That's an interesting concept. Definitely talk about that.
Oh yeah, let me put a pin on that one too.
Yes. So now what they're doing is they're coming to a central location, in this case, RealtyMogul, because RealtyMogul is a source of information and access to operators, kind of in the same way as a fund manager was, but with a different function. So explain how that is different.
Yeah, so the difference is that the institutional investors, or actually individual investors too. I happen to use this presentation for a group of Japanese institutional investors. So it's
Did you do it in Japanese?
What's that?
Did you do it in Japanese?
No, I did not.
Next time, ask me along and I'll do it in Japanese.
I did it in Japan, but I presented in English.
Okay.
So it allows the investors to invest directly into the sponsor's entity. They're not actually investing in RealtyMogul, they're investing with the operator. So, that doesn't work for all operators. Clearly you've got to be institutional quality to be, prepared to do that. The one buffer that RealtyMogul does provide is in instances where we are, a majority, we will aggregate the, some of the decision-making authority of our investor, of the investors going through the RealtyMogul platform. And they're not our investors, they're the sponsor's investors. I just want to make that clear. But for example, if we may have certain trigger rights in the same way that a closed-end fund manager would. For example, if the operator said, we expect that we're going to have a three-year hold program on this investment, there might be a trigger in the operating agreement that allows RealtyMogul, or I should say RM admin manager, that entity to trigger a sale or force a sale of the asset. So I'm probably going too deep right now.
Yeah, it's okay. No, it's interesting, and it is important that you do retain rights.
But yeah, not all platforms do that, and we would only do that if we have a majority interest. And that's something that I think is not well understood in the crowdfunding world. So maybe that's a topic for another podcast.
No, that is interesting. It's very important. I do have a slightly separate question, but let's just kind of underscore that point. The point is that by investing, so this the first slide that we've got, institutional investors invest in RealtyMogul. In fact, I'm not quite sure. Invest through RealtyMogul with operators, but that's only if RealtyMogul also invests. Is that correct, with the operator?
RealtyMogul does not. We may be a co-issuer, but we do not invest. All the investors invest directly with. Well, let me back up for a second, because we do also have a REIT, and there are times when the REIT will co-invest with the individual investors. So thank you for clarifying that.
But when you draw money into these operators, you negotiate terms that individual investors wouldn't be able to negotiate themselves, because you are bringing so much capital. So the operator is going to be more inclined to agree to certain terms that trigger terms that individual investors wouldn't be able to get. But here's my question. Now we're back to the fund manager question. One of the big advantages to an institutional investor of going to a fund manager is they don't have to do all the work to figure out who are the great operators, right? They don't have to do the due diligence. They only need to do due diligence on one entity. That is the fund manager. They're confident in the fund manager. They know the fund manager is going to do their homework. That's part of what the fund manager gets paid for. So in the same way, to what extent can institutional investors coming to RealtyMogul or looking at operators through RealtyMogul benefit from RealtyMogul? What value, what extra value do you bring in the same way? Do you vet sponsors? Do you underwrite them? Do you underwrite the deal? Like, what is it that institutions see in coming to you that makes it useful for them and help?
Well, I mean, quite honestly, that was the other thing that impressed me when I joined RealtyMogul. The underwriting process is really not that different from what I was used to at Rockwood. I mean, very rigorous, zero-based analysis of the sponsor model, third-party review of all third-party documents, property tours, legal diligence, background checks, really the whole, but really institutional quality review.
That's really interesting, and that's very, very important. So when institute, because I really want to get to this last slide, I don't want to run out of time. But when institutional sponsors come to you, they know that you are conducting this is really the distinguishing difference between institutional quality real estate and non-institutional. It's not the real estate. I mean, there are some aspects to it. It's got to be scale, certain criteria, et cetera, et cetera. The key is the due diligence that's gone in to underwriting and understanding if this deal passes muster. That's the key difference. See, so many people, don't you, Chris, these days, oh yeah, we've got institutional quality deals. No, you don't. They can't make that claim. Might be big, but it's not underwritten in the same way as an institutional quality deal. That's the differentiating characteristic, isn't it?
Mm-hmm. Absolutely, sure.
And so the second part of this slide, you've also got institutional investors all pointing to RealtyMogul without an operator. So what's that about, that one?
Oh, yeah, that was, we do have a direct acquisition program also. Yeah, I don't think I mentioned that, but we do occasionally serve as general partner. It's interesting how that evolved because, sometimes we would see a transaction that we loved the transaction, but we just couldn't get comfortable with the sponsor. They just didn't have the right track record. So what we would do is we would often pair them with, with some of our top sponsors, and they would work out a joint venture relationship, and that had mixed results, really, and to the point where we said to ourselves, "Well, wow, we could do a lot better job at this than they could." We have an asset management team. And so now we've built out our GP program. We'll sometimes do co-general partner relationships where, we will be the co-GP. We also have a group within RealtyMogul that acquires directly. And then oftentimes you'll see on our platform where we acquire something as a GP through our REIT, but we'll also make it available to individual investors through our platform.
Fascinating.
So we've raised probably, I think we've raised about $30 million that way, supporting the direct GP this year.
Fascinating.
So far.
All right. So let's get to the next slide because I hope it's the next one. Yeah, it's the next one. The next one is the
Oh, sorry.
Yeah, you're in charge. You're driving.
Oh yeah, I forgot. So basically, this is what happens when the difference between the old model, which I'll call the closed-end private equity fund model, versus the new model. In the old model, the same deal, 20% return. the deal starts off at a 20% return. The real estate operator takes their promote. Typically it might be 20 over an 8, and then another hurdle getting all the way up to 50-50. And then once the cash goes into the fund manager will typically take a 1.3 or 4% annual asset management fee, in addition to the 20% promote over an 8 or a 9% return. And then the gatekeepers they'll charge a little bit, not a lot. And then ultimately, 12 to 14% will actually filter through to the investor, to the institutional investor. In the new model, same 20% return, same 3 or 4% to the real estate operator. RealtyMogul or other crowdfunding platforms do charge, typically annual asset management fees, in addition to, technology fees in the beginning for onboarding new investors and so on. But, that savings flows through to the institutional investors or individual investors. So to think that with this new model, you actually get higher returns than a $100 billion state pension fund was pretty exciting to me. That and that whole model could be disrupted.
Yeah, it's fascinating, isn't it? And actually, kind of approaching it from a slightly different angle. Let's go ahead and stop share, if you don't mind. Mm-hmm. I'm gonna force that. There we go. The other aspect of that, and that last slide was the one that I was really interested in. I'm just going to look at it on this screen over here. Is that what you have now that you never had before? And this is what's so fascinating, Chris. Seriously, this is what I think is what's really fundamentally changed in commercial real estate capital formation. So I'm going to be careful because a lot of this is beginning to sound cliche, but let's really be precise on what I'm going to say here. You now have access to institutional quality deals. But what I mean by that, and this last slide, this last section here is what's so important, is that what you show in this last slide is that you show, quote, institutional investors investing with and through RealtyMogul. Alongside, you've used the term to retail investors. So let's just call them individual investors. Mm-hmm. You've got institutional investors. Individual investors investing in deals with institutional investors. And what's so powerful about that is that now you have, in your case, RealtyMogul doing due diligence, but you know that the institution with its professional real estate, lifelong real estate analysts and pros inside there who are fiduciaries to massive amounts of money and millions of people ultimately, that you are also investing in deals alongside that. There is probably no better way to reassure yourself that you're investing in a real estate deal that has been well examined, right? Basically, it's not random. That's the challenge of crowdfunding, is you can go online and there are so many people out there. The ones that frighten me the most, the ones that, and it's ironic because it's what I do for a living, but the ones that are really good at digital marketing or at marketing, but actually know naff all about real estate. They just create really good personas online that kind of give the feel that they know what they're doing. And so, hundreds of millions are going into deals like that. But there is no due diligence at the end of the day. No one's really checking their work, unlike with you, right? That's the fundamental difference. That's what I was talking to Jeff about, Jeff Dorman over there, IREI, Institutional Real Estate Inc. which I actually managed to get wrong in the intro. So I'm just going to reinforce that as a credit to him. I'm sorry about that, Jeff. So what do you make of it? That's really important, isn't it?
Oh, absolutely. And the one thing that it was probably been 2 or 3 years since I've made that presentation from those slides but I was making that presentation to one of the largest institutional investors in the world. And they were trying to figure out how to access the US market. And one of their biggest concerns was timing. And the way these funds work is, if you think of it, let's say a typical real estate cycle is 8 to 10 years. The way the money tends to go flooding into the closed-end private equity fund model just at the wrong time.
Yeah.
So when I was at Rockwood, and we weren't alone, but we raised $1 billion in 2008. Well, in that case, we were very lucky, right?
Well, you were, because you actually could come into the market with, and buy up the bargains. But
we closed the fund with a big war chest of capital. But our fund before that, we also had $1 billion in 2006. And I'm not suggesting that Rockwood deliberately, tried to, invest the cash quickly, but the money goes flowing into the fund managers just at the wrong time in the cycle.
There's conflicts. Look, it doesn't matter who or what or why. It's the basic structure, right? The structure is that if you've got people who are running a closed-end fund or a private equity shop, and they have capital, they are only going to get paid when that capital gets deployed, and they're only going to get paid when it comes out of the cycle. It doesn't matter if it's closed-end, open-end. If you're aggregating institutional capital, that's how it works. And
they're investing for 3 years. So the state pension fund is saying, I'm giving you $50 million to invest over a 3-year time horizon. I mean, maybe even 4-year time horizon. It's very difficult to call that just right. With crowdfunding, or with the technology allows you to invest immediately. You don't have to have your capital sitting in a pool. And so I envision a world where, the institutional fund managers, there are now 4 or 5 different groups that have institutional quality teams. They put institutional quality projects up on their platforms to access the sponsors directly, and they have institutional, they're institutional quality transactions. So with not a lot of staff, you can, because a lot of these groups, they might have $100 billion and 4 people on their team. So they don't necessarily have the bandwidth to, make, 50 investments every year. But, I would see a world where the institutional investors can, allocate directly from, using the various platforms.
Yeah, you know what else? The other thing is diversification. I mean, we talked about this a little bit before. The idea is that you would go to an aggregator, and not an aggregator, fund, right? Fund manager, closed-end fund manager, or private equity shop, whatever it is, who would go out, and then you wouldn't have more than 10% in any particular deal. But you could almost have 1%. You can almost have half of 1%, spread it out. And the chances are overall, as long as there isn't any major macro impact, yeah, you're gonna hit some pretty. You could almost do it in almost like a mutual fund, right? Invest so little and just aggregate it across so many deals that the chances of the entire portfolio. I'm just playing with ideas, right? It's hypothetical. Mm-hmm. But it almost leads to a different model altogether for investing very large sums of money. Ultimately, it's possible, right? I was actually coming at it from a different perspective, and that was the idea that because individual investors, ultimately pension funds, endowments, insurance companies, Chris, at the end of the day, they're investing individual people's money, right? You think of them as being, so they're really investing the same money that you're raising from individual investors. The same people. Those individual investors are paying insurance premiums and, and writing checks to endowments and et cetera, et cetera. It's actually all coming from the same place. You could almost see a balance. My thesis is, my theory is, what's going to happen is institutions, instead of rejecting the idea of crowdfunding, which lots of sponsors worry about, some of our clients who have only got institutions as our investors, I'm worried that they're going to not like us going to the crowd. Well, on the contrary, it's beneficial because the institution, I want to go too long on this. I've got 3 quick questions to ask you. But I want to make this point. The institutions now can look and say, look, go for it. We really encourage it. In fact, instead of, why don't you add an extra 35%, allocate an extra fine, instead of 30% equity or 20%, do 25% or 35%, go to the crowd. And now we're actually servicing those people as well, because they're getting the benefits of our due diligence, our analysis, all the research we're doing. It's better for them, and they can diversify. They'll have investments through us, right? And their pension funds, which is the low risk, lower down the capital stack money. And they can have a flutter at the higher risk equity side, knowing that we've underwritten the deal. So I just think ultimately that's what you're going to see happening. Do you see a marriage between these two parts of the industry?
Well, I thought I had thought of everything, Adam, but I had actually never thought about that. So
yes,
bravo.
That's how to pitch to institutions. That's what I'm working up doing. Don't worry about the crowd. In fact, embrace it. It'll serve everybody's interest the better. 3 quick questions, if you don't mind. Sign off questions. 3 questions. First of 3. First for 10 points. Chris, what are the key daily habits that you have personal habits that make you successful and productive?
I get up very early in the morning.
Do you? How? I bet I can beat you.
I think this morning I got up at 3.
You beat me by an hour. You're a monster. That's really early. All right. So good. But how does that help you? Why is that good to get up so early?
Well, I always tell my daughters, the early bird gets the worm, right? So I feel like, I'm up, I'm, blowing through all my emails before, most people are even awake. So, and that means I'm tired at night and I go to bed. So I'm not staying up till midnight every night.
Watching television and wasting time that way. Exactly. That's exactly right. By the time everyone else is getting out, you've done a half day's work. I know it's a wonderful feeling, isn't it? Second question. All right, come on, Chris. What has been the hardest lesson you've ever learned in real estate? What's been the hardest lesson in real estate?
Probably, investing in land. When the bottom falls out, it's gone.
Yeah.
Now it's a very exciting investment. I've done a lot of it, done very well. But it's one of those things where even after, you could be through 2 or 3 cycles, and I shouldn't say you, I should say me. It's very tempting, but there are times when the real estate world, the real estate market and the capital markets move on different paths, and you just do not want to get caught on a mismatch of those cycles. So that's a big one.
Yeah, and land actually, I discovered during the last downturn when I was at the bank, brought into the bank to help with their balance sheet, clearing out all real estate collateralized stuff. The land has negative value. Why? Because not only does it pay income, but you got to pay taxes, insurance, put up fences. Not good. So I'm totally with you on that. last question, last of the three questions. So for somebody, an individual investor, well, it's actually my question is an individual investor, but you could talk about an institution as well if you like. Actually, let's talk about an institution. Let's stay on topic. For an institutional investor listening to this podcast and wondering about crowdfunding, what's the most important thing they should keep in mind? What should be forefront of their mind when they are curious about taking a step into the crowdfunding world?
I mean, I think they're looking at the future. I think they need to understand that, I was one of those people. When Jillian asked me to be CIO, I would agree to do it, for a small window of time. And then I was just fascinated when it kind of all hit me. But, aggregating investor capital is an extraordinary, in a compliant fashion, is an extraordinary, painstaking task. And the technology and the process has just made it, and not everyone, by the way, but it has just become so seamless. And I just think that there's so much opportunity out there, and it's fun, right? It's being a real estate investor is fun. Well, when it works, it's fun when it all works.
But it's interesting you say that, and we do need to wrap up. So going all the way back to where we started, and you just touched on this, and I'm so glad you brought it up, but I do want to go full cycle. You mentioned that you suggest it's just the beginning, right? You're seeing something really huge developing. And this is the point, that when you described the beginnings of institutional investment in commercial real estate 20, 30 years ago, like Jeff Dorman again at IREI, there was no investment by institutions in real estate. And today they utterly dominate in terms of dollar amounts, investment in real estate. That what happened to institutions 30 years ago is exactly the point that we are at today with crowdfunding. We are at the very beginning of a fundamental shift in the way that real estate is financed, right?
Yeah, it's exciting. I've been at RealtyMogul almost 4.5 years now, and I still get excited, when we launch a deal and I get a report every morning at 7. I'm often waiting for it on my that automatically calculates how much capital has been raised over the last 24 hours, and often without any human intervention. So it's pretty. I know our IR team works very hard at answering questions, but it's just. And as someone who has tried to raise syndicated capital without the technology, it's not easy, the individual meetings, but the technology just makes it so seamless and safe. I should say safe from a compliance perspective when that's all buttoned up.
Chris Fraley, Chief Investment Officer at RealtyMogul. What a pleasure. I'm so happy we met. Thanks so much for joining me today on the podcast.
My pleasure. Thanks, Adam.
All right, that was Chris Fraley, Chief Investment Officer at RealtyMogul. Very deep thinker and a fascinating fellow. I really enjoy talking to Chris and look forward to having more interesting conversations with you. Be sure to go to GowerCrowd.com and sign up for our newsletter. There's all kinds of calls to action, all kinds of buttons there that you can sign up. Also, check out the news channel, which is there under the news button at the top of the page. It is the most comprehensive real estate crowdfunding source for all information on real estate crowdfunding. We really do cover everything. It's totally free and it covers the latest news, updates, and information, everything that you could want to know about the industry, all there at GowerCrowd.com. Chris, thank you so much for joining me, and thank you too for listening in. That is all for today. Be well, stay safe, and for now, this is Adam Gower signing off.